5 critical mistakes to avoid when buying a triple net lease investment property. As I have heard many investors say, I just want to put 20% down and I'm gonna get an 80% loan. Well, that's a huge critical mistake. And you might immediately think, but why I cannot put just 20% down and 80% loan? And I'm going to explain you why later in this video. We all like familiarity. The best property is not the one that is close to where you live. The best property is the one with the best location, the strongest tenant, and the best real estate fundamentals. Yes, we all want high cap rates, and there's nothing wrong with that. But are you willing to assume the additional risk that comes with it? The higher the cap rate, the higher the risk. And the lower the cap rate, the lower the risk. If you are going to remember just one thing about this video, remember this. Always pay attention to how much rent per square foot the tenant is paying, and ask yourself, if the tenant leaves or not renew the lease, what are the probabilities that I can find another tenant willing and able to pay the same amount of rent? A $200,000 annual rent will mean that Starbucks is paying a humongous $74 per square foot in that location. And ouch, that one is really costly. This one is the most critical. So stay with me until the end because I am going to give you some eye-opening examples. Yes, we all want the best deal and the lowest price possible, but there are certain thresholds that we must meet in order to avoid that our offer be rejected right away. And our job as your broker is to get the best deal for you. Hi, my name is Alex Casablanca. We are a boutique brokerage firm based in Orlando, Florida, specializing in selling triple net investment properties. We represent triple net buyers and 1031 exchange investors as well in finding and negotiating the best triple net property according to their investment goals and risk tolerance. Buying a triple net lease property will be one of the most important financial decisions that you will ever make as an investor. You want to be at peace when you buy the property. You want to be at peace 1 year from the day you purchase the property, and you want to be at peace 10 years from the day you purchase the property. So it is very important that you choose wisely and avoid these 5 most common mistakes that could affect your investment in the future. So let's deep dive into our top 5 most critical mistakes to avoid when buying a triple net property. Mistake number 1. Buying or pretending to buy a triple net property with a high leverage financing structure. As I have heard many investors say, I just want to put 20% down and I'm gonna get an 80% loan. Well, that's a huge critical mistake. In the context of a passive income triple net property investment in which cap rates trend lower, a high leverage financing structure would be a transaction in which the proposed loan to value would be above 50%. And you might immediately think, but why I cannot put just 20% down and 80% loan? Well, I'm going to explain you why. First and foremost, a triple net lease property is a passive income investment in which the tenant takes care of pretty much everything and your rental income is net. As a result of that fact, the cap rates of triple net lease properties are going to be lower than a traditional commercial real estate investment property. Therefore, in most circumstances, the cap rate will simply not sustain a high leverage financing structure, especially in the current interest rate environment in which commercial mortgages are still in the 6 and even 7% interest rate and above. In other words, it will make no sense to buy a triple net property with an 80% loan to value mortgage in which that mortgage interest rate can be 6, 50, or even 7%. In a high leverage structure like that, the cash flow numbers are not going to add up. The majority of the rental income will go towards paying the mortgage. And the hidden risk really lies behind. If by any chance the tenant might decide to leave early or not to renew the lease, the property will rapidly decrease in value as a result of the loss of income. And that will trigger the bank to jump on your neck right away, asking for a capital contribution to restore the original loan to value. And ouch, that one is really costly. And no one out there are talking about that risk. If you are considering buying a triple net property with financing, you should not leverage more than 50%. And even leveraging only 50%, you might still be in a position in which most of your rental income will go towards paying the mortgage, leaving you with not enough passive income cash flow. You should carefully review your numbers and make sure that the cash-on-cash return will meet your expectations. Mistake number 2, buying or pretending to buy a triple net lease investment property with a high cap rate, but ignoring or not willing to assume the risk involved. The cap rate is the first focus of attention for every investor. We all want to buy a property at the highest cap rate possible, and there's nothing wrong with that. And it is perfectly understandable. However, the cap rate is in direct correlation to the level of risk involved in a particular transaction. It is important to highlight a very basic concept of investment. The higher the yield, the higher the risk. And the lower the yield, the lower the risk. This simple concept applies not only to triple net properties, but any type of investment, whether it's real estate, bonds, mutual funds, among others. Bear with me on this. Every property that is being offered at an above average cap rate will come with a higher level of risk, whether it's just a few years remaining on the lease, or a substandard location, or a weak franchisee, among many others. And now the question is, are you willing to assume a higher level of risk in exchange of a higher cap rate? Every investor has a very different risk tolerance profile. Some investors are conservative investors and feel more comfortable with just a low-risk passive income investment, while some investors are risk takers and they are willing to assume a higher level of risk in exchange of a higher cap rate. Remember the key concept here. The higher the cap rate, the higher the risk. And the lower the cap rate, the lower the risk. None of those two extremes are necessarily wrong. As an investor, you have to determine what is your risk tolerance and then set your cap rate expectations according to the level of risk that you are willing to assume. Does that make sense, right? Mistake number 3, focusing only on properties that are located in your local state or close to where you live. We all like familiarity. We all feel more comfortable buying a property that is close to where we live, and that's certainly a value added. However, the best property is not the one that is close to where you live. The best property is the one with the best location, the strongest tenant, and the best real estate fundamentals. The property that is closer to where you live might be the worst investment that you could ever make. And the property that is in a different state could be one of the greatest investments that you could ever make. If you can find a property with those characteristics close to where you live, that would be great. It would be an ideal scenario. However, more often than not, the best property is not close to where you live. So it is important that you keep your possibilities as open as possible so you can find the best property for you no matter where it's located. Mistake number 4, submitting offers substantially below the asking price. We all want to buy a property at the lowest price possible, and that's perfectly understandable. But by submitting offers substantially below asking price, that will not attract sellers' attention and will probably be discarded right away as a low blow offer. But the question that you might be asking is, what could be considered a substantially low offer? As a rule of thumb, in a competitive market, an offer should not be lower than 10% of the asking price, or no more than 0.5% above the asking cap rate. A big however here. There are exceptions to those guidelines. Every property and every situation is different. There are circumstances in which a 20% below asking price could be a reasonable offer. Certainly, there is always room for negotiation. How much room for negotiation it might be, it will depend on several factors, such as how many offers the seller has received for the property. If the seller has received multiple offers close to asking price, in that situation, if you want the property, you might have to come up with an offer either close to asking price or at asking price. On the contrary, if the seller has not received any competent offers, chances are that the seller might be willing to be more flexible in reducing the price. The key concept here is reasonability. Let's assume that you are selling your own property and you receive an offer 20% on their asking price. What are you going to do with that offer? Probably you will throw it on the trash can, right? As your buyer's broker, we are very diligent and assertive in negotiating offers on behalf of our clients. We have the knowledge, expertise, and more importantly, market connection that give us access to those intrinsic factors that can push the price lower in favor of our clients. And finally, the last one, the number 5 most critical mistake to avoid when buying a triple net lease property that no one talks about. Always pay attention to how much rent per square foot the tenant is paying and ask yourself, if the tenant leaves or not renew the lease, what are the probabilities that I can find another tenant willing and able to pay the same amount of rent? Buying a triple net property in which the tenant pays a substantially higher annual rent and rent per square foot, that in the event that the existing tenant would leave early or not renew the lease, it would be almost impossible to find another tenant willing and able to pay the same amount of rent. But let's decompress this situation real quick. I am going to give you just one simple example of that. Let's take as an example a typical Starbucks that occupies a small 2,700 square feet building, that it is located in a prime top retail corner. To be in that location, Starbucks had no other choice but to pay a hefty annual rent. Let's say $200,000 per year might be the average, and commit to a 10 years lease. A $200,000 annual rent will mean that Starbucks is paying a humongous $74 per square foot in that location. And now the question is, if at the end of the lease, Starbucks might decide not to renew the lease and leave, what are the probabilities for you as an owner to find another tenant willing and able to pay the same $74 per square foot on that building? I can tell you right out of the bat, it would be very difficult, considering that there are no other coffee brands with that financial capacity of paying such a high rent. Certainly, you can find another tenant, but it is not about finding another tenant. It is about finding another tenant that can pay the same $74 a foot that Starbucks was paying. That's the only way to restore the same value of the property. And that is why the mistake is so costly. Going back to that $200,000 annual rent that Starbucks was paying, at a cap rate of 5%, the value of that property would have been $4 million. But if Starbucks leaves or not renew the lease, and the only thing that you can find is a tenant that can only pay $100,000 in annual rent, then the value of the property would be half the price you paid. In other words, if the new tenant can only pay $100,000 in annual rent instead of the $200,000 that Starbucks was paying, now the new value of the property will be just $2 million. So half of the price that you pay for. And ouch, that one is really costly. And no one out there are talking about that risk. If you are going to remember just one thing about this video, remember this. Always pay attention to how much rent per square foot the tenant is paying and ask yourself, if the tenant leaves or not renew the lease, what are the probabilities that I can find another tenant willing and able to pay the same amount of rent? As I mentioned before, buying a triple net property will be one of the most important financial decisions that you will ever make as an investor. When you buy a triple net property, you want to be at peace when you buy the property. You want to be at peace 1 year from the day you purchase the property, and you want to be at peace 10 years from the day you purchase the property. So it is very important that you pay attention to those small details and avoid at all costs those 5 critical mistakes. Of course, those are not the only critical mistakes that you could make as an investor, but we picked those 5 because I believe that those 5 are very, very costly. Hiring an experienced and knowledgeable buyer's broker that can assist you navigating the complexities of the market would definitely help you to avoid those critical mistakes. At Casablanca, we specialize in representing triple net lease buyers and 1031 exchange investors. We have the knowledge and expertise to guide you along the way, from market research, identifying potential properties, submitting offers and negotiating them, due diligence, up to the closing table. We have helped many triple net buyers and 1031 exchange investors in finding and negotiating the best triple net property according to their investment goals and risk tolerance. Moreover, we represent our buyers for free since we get paid from the seller. And we also pay for our buyers' closing costs up to a maximum of $10,000. This incentive will offset and in some instances will cover completely the major buyer's closing cost expenses, such as title fees, attorney's fees, recording fees, among others. We are the brokers that give you more in exchange of your trust. If you have any questions or might need guidance with your upcoming triple net lease property acquisition, feel free to contact me directly and I will be in contact with you. Well, you got all the way into the end of this video. So thank you very much for watching the video entirely. And if you found this video helpful, please give it a like and consider subscribing to the channel for more videos about triple net lease properties. If you want to know more about the best triple net properties to buy for your 1031 exchange or for your triple net acquisition, you can watch this video here that will tell you how to do it. So thank you so much again for watching this video, and I'm looking forward to be your broker in your next triple net property acquisition. Have a great day.